Welcome, everyone. This is Julia Stewart from J. Dalton Trading. It's Jim and my pleasure to be hosted by Cynthia in the Fluidity Trader room and have this opportunity to share Jim's work with everyone. So thank you, everyone, for being here. We are recording this, and we'll be getting a recording out to you so you can review it, or if you can't stay for its entirety, you can watch it later. And we thank Cynthia very much for giving us this opportunity. It's great to, work with new traders and to share Jim's work. So we want to thank Cynthia and thank everyone for being here with us today. And with that, I'd like to pass it over to Cynthia.
Good Thursday morning, Fluidity Traders. Welcome to the webinar with Jim Dalton. Thank you guys for coming in today. We are honored to have Jim as our guest this morning. I do not have charts this morning, so I am going to turn it immediately over to Jim. We are just a few minutes ahead of the market opening. Jim, take it away, and thank you so much for being here with us. We really appreciate it.
Okay, Jim, are you there? We don't hear you.
Okay, can you hear me now?
Yes, sir.
Okay, once again, Cynthia, thank you, and welcome to all your Fluidity traders. Questions are welcomed at any time. We've got about 12 minutes before the opening, so what I'd like to do is give you a briefing of what's should have already been sent to you with our early comments. What you see on the bar chart in front of you are basically two distributions. The one distribution starts at the 1695 plus level and above, and the second distribution or lower distribution is 1695 and below level. The overnight high has been 1695.50 on the E-mini.
Jim,
So
may I interrupt you? I beg your pardon. I don't think we can see, I can't see your charts. Could you show your screen? Okay, great. Thank you.
Okay, you can see my screen now?
Yes.
Hello?
Yes, we can see your screen.
Okay, all right. So what I was saying, we have two distributions, the 1695 level and above, the 1695 level and below. The 1695 level divides those two distributions. As you can see, we've been using that for some time. You can also easily see that the overnight market at 1695.50 also recognizes that as an important level. So we see that as a go, no-go level this morning. By that it means we either fail at that level or we start to accelerate higher. At least that's the potential. Anything can happen, but we generally look at it from that perspective. Now, this morning, I'm going to go over to put up the market profiles, and what you will see is this was 1689.50 was yesterday's high. The overnight inventory is here on the right. So 100% of the overnight inventory, this was yesterday's settle. So 100% of the overnight inventory is long. All we do to make that determination is see if the overnight inventory traded above the settle, then it is long. If it traded below the settle, it's short. If it traded equally back and forth through the settle, then we would say the overnight inventory is balanced. When the overnight inventory is long, that is generally a, hold on, that is generally a negative for the market. I say generally. so many times you will see the market correct for excessive overnight inventory. If the market doesn't correct for overnight inventory, then that is usually an indication of a market that is very strong. For example, yesterday's overnight inventory coming into yesterday was short. It was right in here. The market didn't care, and the market broke very hard early in the day. And I had written yesterday morning, if it didn't care, that was a sign of weakness in the market. Today, if it doesn't care about the long overnight inventory, that is a sign of strength. Now, additionally, since we would gap higher at this point in time, gap trading rules are in effect. What the gap trading rules say is to go with all gaps that aren't filled fairly quickly. If the gap is filled, then unless the market can move to value that is least overlapping to yesterday or unchanged from yesterday, then expect a late rally in the market. At least that the odds are you would get a late rally. So yesterday's value was right in here where you see the blue line. This is the high, and this is where we currently are right now. We're right on the highs, and we've got about 7 minutes before we open. The larger the gap, the greater the odds that the gap will not be filled on that day. And the reason for that is when it gaps in this way, in this direction, in this instant to the upside, the bigger the gap, the more likely it is that there's an awful lot of traders caught short in the market. Now, I want to go back and very quickly take a look at the bar chart from yesterday. The two most important things or elements we ever deal with are balance and excess. This is excess. The market looked down. This was yesterday's low. Market looked down here and was rejected off of this low fairly quickly. This is the overnight trade right here. So we did have excess from yesterday. If that excess holds, the odds are that we're going back to test and take out the long-term rally high. Okay, let's go back to the profile. Now, before we open, let's go ahead and field a few questions.
Thank you. We have
Any
a question.
questions out there?
Yes, sir. Since 95 is a go, no-go level, would any attempt to fill the gap be considered bearish, even if it didn't fill?
Hello?
Yes. Did you hear my question? Hello, Jim. Can everyone hear me?
No, cut off.
Can you hear me?
Now I can hear you, yes.
Okay, pardon. Okay, since 1695 is a go, no-go level, would any attempt to fill the gap be considered bearish, even if it didn't fill? And that goes back to the gap rules.
No, it would not be, because if the gap isn't filled, then value is going to be higher. Now, the problem is everybody's got a different time frame. So if we trade down below 1695, you may get a short-term correction to overnight inventory. So you could get the market moved down in a very short term to correct overnight inventory and some acceleration once it got below 1695. And so it may be bearish for just a few minutes. So again, it's always a question of time frame. If in fact the gap is not filled, means value is going to be higher, that is a positive, or that's bullish for the day. Again, so much of this is in time frame. I look to do 2 or 3 trades a day, looking for good trade location. A lot of traders are trying to do 15 and 20 trades a day. Okay, generally most traders overtrade. I know very few traders that try and do 15, 20 trades a day that are successful in the long run. The people I know are successful try to do fewer trades, looking for good trade location. So that's an answer, but it's a time frame question. Now, if in fact the market opens and starts to trade quickly below the 1695 level, it is a legitimate place to put a short-term short. But you want to have your stop very tight, because if we trade down below 1695 and can't hold it, then the odds are pretty good we come roaring back through it. Another question.
Thank you. Although PO, and before I ask this question, we addressed this specific question in our member article 80, Forcing Action. Although POCs are important references for trading, do you consider them as targets for a trade when the market is testing a balanced range as opposed to a balanced extreme? Is there a certain TPO count for POCs that you see as a threshold for determining the POC's importance?
Well, I break them down into normal, prominent, and very prominent. And I can't tell you how many ticks wide that is, because each commodity or futures are different. But if you look, for example, in yesterday's POC, this is the POC from yesterday's S&Ps. I would consider that to be prominent. Very prominent, would probably cover another 2 or 3 periods. That POC is really not relevant to me unless the market starts to trade lower and starts to elongate, and I see I can get into yesterday's range. If that happens, then I start to focus on that POC. The first thing I will look at this morning is the gap and the 1695 level. That's going to be my first immediate focus. What I say is the market has to take care of current business first, and the current business right now is that the overnight inventory is long. We are at the 1695 level, which I think the world has probably identified as a pretty important level. So I try and take current business first. The current business first is going to be what happens relative to the 1695 level. Am I going to look above it and get rejected? Am I going to look above it and get accepted? That's going to be what I'm focused on when the market first opens. Now, just so you know where I am, let me show you, let me give you a trade. I went home long calls last night. And the reason I went home long calls is because I had this excess and because I had a very poor or no excess on yesterday's high. One of the things that happens, you get a tone for the daytime frame, and the daytime frame was trading this upper distribution. When I looked out to one longer time frame, longer distribution, I saw excess. So as a willing to trade beyond the day time frame, I saw something different than did a trader that had to go home flat yesterday. So with this no excess on the high, good excess on the lows, I thought it was worth an opportunity to go home with calls. Okay, the market is open. As you can see, we opened at the opening. It looks like at 1695, and the market is trading higher at this point.
Can you show, excuse me, can you show yesterday's profile? Just drag your screen to the right so we can see the action from
here's yesterday's profile.
Right, the day before, Tuesday's profile, just so we can see it all, because there's a prominent POC up there as well that was taken out overnight.
There's Tuesdays. There's yesterday's. Okay, this POC was taken out overnight. Okay, so it's something we carry forward. Okay, so right now, the market has looked above the overnight high. The overnight high is always, the overnight high and the overnight low are always references that I use. If there's going to be a failure, it will more than likely occur above the overnight high. So now we've, at least for right now, we've failed above the overnight high. The next thing we will be looking for is to see if the market can test back down below the early morning low or the 1695 level. So that's where our focus is right now. I'm going to switch over for a second, and we're looking at Window Trader. Let me make this, I can't make it bigger because I don't have my mouse with me right now. I hope you can see it. there's the volume taking place, the actual volume. On the far left is the total volume, and right next to the profile is the volume taking place for this period. They will be the same early on. As you can see, we've now looked above the overnight high, and if you are an aggressive short-term trader, that is a legitimate short. If you were to do that short, I would have my stop right up at that high. If you don't leave that high, you don't have anything on the downside. So it's a legitimate short if you're very agile. It is not a legitimate short if you're going to overthink the situation. If you did that short when we looked above the overnight high, you have to be willing to get out in a second if that market comes back up and takes that high. Right now, we are below the 1695 level. If you did an early morning short, then you put the trade on and you monitor for continuation. To get continuation, you need to find acceptance fairly quickly below the 1695 level. If you don't find that acceptance below the 1695 level, then the odds are pretty good that the market is going to pop to the upside. Right now, it's in a very tight range. There's still a lot of indecision going on in here, but it is clear that at least so far there is no real aggressive selling. So I'll take some questions. If I made anything clear or unclear, come in back at me and let me try and take a couple of questions.
Okay, thank you, Jim. And right now, if you could mark hold the control key and left click over yesterday's high, obviously the market is trying to approach that and fill the gap. And we'll be watching volume to see if it's drying up there. It's a natural place on a dip to take a long for many traders. But that, I don't know if you can mark that reference, Jim. You hold your control key down and left click.
It could be showing. It's right there. I marked it, didn't it? Right there.
Okay. Okay. On Tuesday, you said place trades on the extremes. Can Jim define his personal criteria to determine extremes? Like today, you said yesterday was extreme at the lows. Would you be willing to go long at yesterday's low?
Yes, and the reason what you had yesterday, I'm going to go back to. I'm going to go off of this for a second. I will tell you right now, you're not getting any great selling so far on the downside. I'm going to go to back to my other quote system, commodity quote graphics. I'm going to use a bar chart. And what you will see, you have a low right here of 1680.25. Yesterday's low was 1680.50. One of the things you will find in markets is that they are very visual. The fact that the market went down to within a quarter tick of a previous low, it tells me a lot of information. One, it tells me that the selling yesterday was probably liquidation, not a more potent combination of long-term selling and short-term liquidation. If I had a combination of short-term liquidation and long-term selling, the market is very unlikely to stop 1/4 tick above a previous low, a very visual reference. When you see markets trade the very visual references, that is usually a sign that it's short-term money in the market. When I know it's short-term money, then I know that the odds of that market coming back the other way are very high. If it was long-term money, they wouldn't even know that that reference was down there. They don't care about a quarter tick. They're not trying to be that exact. I used to run an institutional trading room, and and we did long-term or big trades. You don't even know about that stuff. You don't care about those things. When I see it go exactly to a quarter tick, I know at that level that I am dealing with short-term money. When I'm dealing with short-term money, you can very quickly see the market reverse. Also, yes, this is a legitimate place to take a long down here because you can put a very tight stop down below this. You can put a handle or so below that. If it takes it out, you've got a new ballgame. Now, right now, I'm going back to the market because as we left this market, one of the things I said before I flipped over, I said it was clear at that point in time that there was no real aggressiveness selling below the 1695 level. I also said earlier, if you took the short when it looked above the overnight high, you needed to be able to change very quickly, and you needed to find acceptance below 1695 if you wanted to stay in that short. Now, I never would have taken this short because I want to see acceptance below 1695. But everybody has a different appetite. When I looked down here in this volume, it was pretty obvious, at least for now, we weren't going to trade down below and get much acceptance. The market is still in a very narrow range. Okay, I just wanted to come back and keep that in front of us. We've now looked twice above the overnight high. So my early confidence is low. 1695 is still a reference. We looked once below it, got rejected. We went back to the overnight high. We're in a very, very narrow range. The market's not going to hold this range all day. Okay, let me go back. I want to go back to the bar chart. And yes, because if you're a short time frame, day time frame trader, you did have a perfect reference down here because that was a previous low. That previous low should have been marked on your charts coming into yesterday. If you haven't marked those, it is very hard to find them in the heat of battle when the market's dropping like crazy. So those are important types of things. How do you identify your references? Have them pre-marked so that you have to do as little thinking as possible once the market gets underway. Now let me show you this. So that isn't a trade, a buy on the extreme. But let me show you another trade. I'm going to show you a couple. I'm going to break this out. Now, early in the day, your market, you had a point of control down here, and then you were trading up here for early on. Let me split off one more period. So you had BHI up here early on. It is very unusual to see this kind of structure. My comment to somebody that called me yesterday about this, I said, you know, more than likely, you're either going to trade back down to here, or over time, this market is going to fill in so that, and time regulates all markets, so over time, we were going to fill in here. The chances were very thin that this market was just going to really trade to the upside. This would be a very unlikely structural thing to see this and straight up above. And that is something as we go through the trading and the DVDs and the intensive course that we're going to get, we're constantly talking about structure and how do you use structure in order to help you trade. Now, later in the day, here is a perfect place for a long. This mark right here, this is the overnight low. This is half back. This lower line is half back where the arrow is, and right above it is the overnight low. Again, I said early on in the morning, because the market went to a quarter tick of a previous reference, more than likely it was daytime frame or short-term traders. Daytime frame are traders that go home flat in each day. Short-term traders are usually 3 to 5 days, maybe a little longer in duration. Their behavior is substantially different than is the behavior of longer-term traders. To get a better feel of this, you should read my book, Markets in Profile. It will give you a much better sense of this. But when I know that it's short-term traders, day and short-term traders, I know that their behavior is going to be different. Just as early on it went to a quarter tick, here it goes exactly, they love half back. And when I see a market traded half back, I know it's probably short-term traders. When it came down yesterday afternoon, let's collapse this again. When it came down yesterday afternoon, right to this level, notice it's one tick above half back, and it is exactly at the overnight low. That is a legitimate long for a short-term trader. So I see this as one distribution, two distributions, and I treat each distribution as a separate day or auction. So there was a buy down here, and there was another buy here later in the day. All right, let's go back and take a look at what's going on today. We're back down below the 1695 level. Confidence is very low. The market is very much unsure of itself. We're just going to have to let it work out. Okay, another question or so.
Can we look at the volume on Window Trader for a second, Jim? And we have a question. At some point, can Jim describe how he makes a trade entry, his decision point?
Okay, there's the volume on Window Trader, and you can see there's no real volume. Most of the volume is, right around the opening. So there's the opening, is the yellow circle. There's a lot of indecision in here. There's no anxiety to go either high or low. Well, there may be a lot of anxiety, but there's no commitment. And the answer to, can I explain how I decide to make an entry? No, I can't. I don't mean to be a smart aleck about that. It is a very personal type of thing. So many times, what traders want to know exactly where do you get in and exactly where do I put the stops. If that question had exact answers to it, it would be put on a computer and it would be arbitraged away almost instantaneously. Now, that doesn't mean that there aren't occasions. We looked at yesterday, and there were two occasions yesterday where I could look down and I could say, okay, here's the place to put the trade. Down at the low and down at the pullback in the afternoon when it went to half back. I mean, those are your ideal trade locations. Then it's a question of how close to that can you put the trade on. One of the reasons I suggested reading Markets in Profile, the nature of traders is, I used to describe this in 5 steps. Malcolm Gladwell has described it another way. He talks about the people that in early as the innovators, early adopters, early majority, late majority, and laggards. This is a tremendous concept to keep in mind. This is the nature. Even though we had an exact place to do a trade yesterday, some people will buy it immediately. Some people will need to see it come off of that a little bit more to make sure it's real, and some people will have to have seen the market go up 4 or 5 handles before they decide it's real. That's something that you need to work on as a trader. And each one of us is going to be somewhat different. I may go, if I've got a lot of confidence, if I see that market coming down to a level and I recognize that it's basically short-term traders today, I have a pretty good idea how they're going to act at those levels. I may act fairly early. Other times I may be a little later because I'm not as sure of myself. But it's something that you have to develop over time. But believe me, if it was a science, it would be computerized and it would be arbitraged away immediately. Part of the art of trading is always understanding odds. And for example, when we came down yesterday to that midpoint, you can sit there and say, well, this is a pretty good opportunity because I can put my stop a 2 ticks below. So you say my risk reward is pretty attractive. And that also will define what I want to do. What I don't want to do, let me go back to yesterday for a second. Here we showed all this trading up here yesterday. Where you don't want to put on your trades is right in here. Now, if you see all the volume, where did most of the people put on their trades? They put on their trades right in here. And here, you probably get whipsaw. It goes down here, then up here, then back and settles in here. So that's why with extremes, I'm talking about the extremes of this distribution, not necessarily the extremes of the day. There's another thing. Sometimes, for example, here's another potential trade from yesterday. When I looked down below this in F period, I broke to the downside, and then when it comes back in and leaves a little excess, this is a legitimate trade here. You got this failure down here, and then it starts to one time frame higher. So an excess low in the day time frame, another legitimate trade. One time frame means this low does not take out this low does not take out this low. So at one time frames from this little excess right here, and incidentally, this was another way to buy as it came down to test that low. If you had this reference in mind, this was another potential buy. Then it one time frames up until right here, where you get the two balanced bars. So you can, when it stops one time framing, one entry, one exit would be right here when it stops one time framing. An inside bar here, another trade that comes out of there. Again, short-term trades. There's all kinds of things you can do. And again, there's not much we can do in just an hour this morning. It's just to start to get you thinking about trade location. What type of things are you looking for in a market? Let me go back over and you see. Remember early on we said there was no clear confidence. Julia asked to put up window trader, and this is what I used. And notice the heavy volume here, and down here it traded lower, and the volume was substantially less. So there wasn't a lot of, there was some liquidation, but there wasn't any aggressive selling. We are still holding at the 1695 level. Value is higher. It's still an extremely low confidence. Additional questions, Julia?
Do you also watch other indicators like the tick and internals and other equity futures like the NASDAQ and the Dow for more information?
Okay, there's several pieces to that information. I do not watch tick, little tick, big tick, those kind of things. And part of the reason for that is, incidentally, I don't follow bid-ask ladders. At one time, I did program trading for PayWeber, which then became UBS Financial Services. There were, at one point, and I don't know, I haven't looked at it for a long time, at one point, there was more money made on program trades that weren't completed than there were on program trades that were completed. What could happen sometimes, we knew how to get the tick. Say, for example, we need markets to go higher to put on our trade. It wasn't that hard to get the tick positive. And once you got the tick positive, what happens, and all the weaker traders come in and all look at tick as positive, and they go running with that tick. And what we would do, we'd get it positive and then use that to sell into it. So there's a lot of games that go on in trading. So I don't use that type of thing. Now, I do look at overall advanced decline. If overall advanced decline is very high, very strong, it's very low odds that the market's going to reverse itself on that day. It seems like I forgot part of the question in there. Oh, do I look at other markets? Out of the corner of my eye, if, for example, I'm trading the S&Ps and the S&Ps are down and the NASDAQ is up. The NASDAQ is a more speculative market. If the S&Ps are down, the NASDAQ stays positive. Out of the corner of my eye, I have a pretty good idea that I'm not going to get a free fall on the downside on the S&Ps. I do look at that. At times, if there's bonds or dollar indexes influencing the market, sometimes I may be aware and keep my eye on that. It's only there was a period of time when the short-term traders were trading everything off of the dollar. At the time I wrote it's craziness because there's no long-term correlation. As it turned out, later on, months later, that made absolutely no difference whatsoever. but it was a game that short-term traders saw. They thought they saw a pattern. The pattern really didn't exist. They made it exist in their mind. It lasted for a couple of months, and I'm not going to fight reality. If that's what they're doing, I become aware of that. But that's not overall what I'm about. Now, at this point in time, we have looked. The market couldn't make up its mind. We went back up a couple of times to the 1695 level, and we're now trying to trade lower. I look down here in this lower right-hand corner. It's 6:52 my time. I know the time is going to change in 8 minutes, so I'm watching to see if I'm going to get double prints down here. So we are seeing liquidation right now. We're down below 1695. It doesn't look like it's strong. I think it's liquidation, but this can change very quickly. The trade when we came back the second time below 1695, the trade is down to the short side, but it's not a high level short at this point in time. We did look above the overnight high. We did look above the 1695 level. There is probably liquidation going on. I would not want to be on the buy side of this market. I would want to be on the short side. But it's not not high level at this point. What you've got to watch, Julia earlier on asked me to mark yesterday's high, so that's there. Also, I want you to remember that we talked early on about the fact that 100% of the overnight inventory was long. And we said when the overnight inventory is long, that can actually be something that helps contain the early advance, because there's already too many short-term longs in the market. Overnight longs tend to be weaker. So if you look at this market right now, we haven't carried and been able to hold above the overnight high. We are getting higher value. We are getting some liquidation, probably of overnight inventory. But at this point in time, value is still higher. We are not getting tremendous volume on the sell side. But I would not be long yet. Okay? Additional questions?
Thank you, Jim. Yes, and just to go ahead, Cynthia.
I just wanted to chime in and reiterate something Jim said earlier. When something that you guys hear from me consistently, 2 to 3 great trades a day. When you're trying to take 10 or 20 trades, you tend to be all over the market rather than really identifying and picking your places to put in low risk, high probability trades. The other thing I just wanted to comment, Jim, just to let you know, this team that you're speaking to today, we are, as a team, reading markets in profile, everybody on the team, and we are actually studying it chapter by chapter, and we are through chapter 6, so we have gone all the way up through intermediate term.
Great.
We'll be doing short term in chapter 7 next Monday. So just so you know, this team is reading and has been through a lot of the innovator, early majority, your structures of how you explain the market, just so that you know.
Great.
Okay, great. Also, the second edition of Mind Over Markets is now out. And while there is very little change in the early chapters, the final chapter is an important chapter in the updated edition. Some of the things in that chapter, when I first started trading, it probably cost me $250,000 when I learned about buying and selling tails. Because all of a sudden, if I didn't have a buying or selling tail, you know, I wouldn't do the trade. Or if the market went up and it didn't give me a selling tail, I wouldn't get out. It took me probably 2.5 years, probably $250,000 that I either didn't make or lost, until I finally realized the importance of sometimes if the daytime frame traders or short-term traders are in control, it is not uncommon not to have a good high or low, or at least an excess high or low. Sometimes that's an indication that the market is too long. And when it's too long, then you have to get liquidation first. Let me go. I'm going to go back to CQG for a second. and I'm going to show you very recent examples. I'm going to take the overnight out of here for a second. And you will see up here, well, hope I can get my little fingers to work a little better. You will see up here at the 1705 level that there are two back-to-back non-excess highs. That indication, when I first started, I would say, "Oh, this market's not over because I don't have any excess up there." Like I say, a lot of money later, in about 2.5 years, I finally figured out that a lot of times, if the long-term money wasn't driving the market, it was mostly being driven by momentum traders and shorter-term money. It was very common to get these formations, and it was an indication that the market had just gotten too long. Now, the other day, we wrote a piece, and here's the 1700 level. What I wrote the other day was the market, the fact that the market wasn't carrying through above the 1700 level. In other words, it got to 1700, which is a very psychological, visual level in the marketplace. And the market was shooting for that. Julia had identified that, a long time back. She said, "I can't believe this market's not going to find its way to 1700. Well, once it got to 1700, that was probably game over, side out for now. That's all that they were doing. And once they got above that, there wasn't any follow-through. 5 handles is nothing in the S&Ps. So more than likely, you had non-excess here on 2 days as well as on the long-term auction. So you really didn't have any sign of any long-term trading over there. However, as you can see, the market broke. We got liquidation on Tuesday. We got more liquidation on Wednesday. That liquidation was more than likely a result of a market that got too high and people getting too excited, or what we would say was the laggards getting long above the 1700 level. Then they got forced out and had to liquidate. As you can see now, we're right back up there. We're going to get higher. We're going to get higher value again today. So it's really important to understand who is in the market, and we try and understand the market more from understanding human behavior than we do from looking at numbers. Yes, I've used points of control like this. It got back to this point of control. It took it a while, but it got back to it. I carry that forward. Anyhow, go ahead. What other questions we got, or what did I not answer?
Well, Jim, can you put Window Trader up just so we can look at the market here and widen the lens on what's happening in today's auction?
Yeah, hold on. Let me see why it's not coming back up. Let me minimize this. I don't know why it's
It looks like it's rebooting. That's okay. Yeah. We can look at CQG, but I wanted to make a comment just in the very near term as we're in the early session in the pit here, that we looked above yesterday's high. We know we're dealing with a gap. Overnight inventory is long. We have one of our scenarios that will be adjusted if for no reason that weaker hands are flushed out and stronger money comes in to buy. We're not seeing a lot of volume on the Window Trader on the downside. However, we also know that it could just be an adjustment of overnight inventory, and as Jim pointed out, value is probably going to be higher today. So any trades to the short side need to really be, as Jim says, agile and recognize that it's got to work for us pretty quickly if we're going to stay short. And, right now it's not unusual for this, not that we use structure in the overnight, but clearly there was a lot of trade that happened at the level 1691 level, and the market has found its way back to that area. But as we look at the volume on the lows, we did see volume come in right inside yesterday's pit range. Again, it looked above. Could it be a breakout failure? Possibly. but right now we're still not seeing the confidence, and at the same time the longs from overnight are not flushed out yet. They haven't felt enough pain, and we'll see as this develops, but we are back inside yesterday's range. We're carrying forward that the confidence is low, and we have some structural references from yesterday's profile, but I just wanted to kind of comment on the broader concepts that Jim is employing as he's watching the market, and as we watch it, utilizing this, these concepts.
Right now, notice that B is trading inside the range of A. If this market's got anything on the downside, you will see the market begin to one time frame. In other words, B will take out A on the downside and begin to accelerate. If B fails to take out A and accelerate on the downside, then the odds increase that this market is going to rally. Right now, all I see is short-term liquidation. I don't see any sign that stronger money came in to sell it. But we will watch. The one time frame is a tremendous tool. So if this market's got anything on the downside, you'll start to see B take out A on the downside, C take out B, then you get down there and start to fill the gap. Now, let me. Sometimes I'm going to give you a spec. I'm going to give you a spec trade, but an interesting trade. And I want to be very careful. I'm not recommending this. I'm only showing for somebody that wants to know how to speculate sometimes with a little less risk. There are options, weekly options that expire Friday. So yesterday, when the market backed off, I commented that I had a poor high up here on the market yesterday. When this market backed off, I was able to buy calls for 404 point, call it just a little over 4 handles, which is $200 an option. I went home with those calls. It's 100% risk, so I'm spending $200 a call. It's 100% risk because if the market just craters, I'm gone. But I thought I had a chance at it. Now, as that market rallies, I get a chance to go short futures against those calls. I don't have to go 100%. I can go 50%. So it's a way to hedge. I don't want to go any more detailed than that. It's just something that is intriguing because it had only a couple of days left for $200 per call. It was not a huge amount of risk. And you see what the market did overnight, and it did allow me to get short some percentage of futures against those calls, and it's a risk-free short because I'm protected by the call. Anyhow, I don't want to confuse anybody that I only throw it out for people that have a particular interest in that area and strategy. Right now, we do not have a good low. A and B have tagged each other, so the market still. We still have the potential to one time frame lower. If I were on the short side of this market, and I would move my stop up to probably about the B period high. I think if there's anything on the downside of this market, I would expect to see a double distribution on the downside. I would expect not to come back. I would expect to see B start to accelerate on the downside, start to catch the overnight shorts, or the overnight longs. So we're getting pretty close. Now we're talking about trade location. This gets tricky. If in fact this gap is not filled, watch out. The buyers can come in pretty fast. If the gap is filled, then the first destination inside this becomes the point of control from the upward distribution from yesterday. Okay, additional questions?
Thank you, Jim. And again, obviously the gap is, it's, we know traders are looking to fill this gap and they're trying very hard. The volume is light. The red indicates high volume. Pink is medium. White is low. And, clearly they're gunning for the gap, but if you're in a short, that certainly is a reference that you want to watch very closely, and it might be exit, because we trade value, not price. Value is clearly higher right now, so we always want to keep that longer term perspective and the context of trading in a gap situation. We're not inside yesterday's range. The context for trading today is different. To ask, we have a question on, do you use the volume POC or the TPO POC? What do you consider more important?
Julia, go ahead and answer that question.
Well, we don't pit them against one another. They're both in our analysis. The time element of the TPO and the conventional point of control, time is one of the main points of the auction. You know, you have price advertises all opportunity, time regulates the opportunity, and volume measures the success or failure of that advertised opportunity. So to leave the time element out of the analysis really doesn't do justice to the auction process. The volume point of control clearly has its place because it's indicating how many contracts were traded. So we incorporate both, and they tend to be similar, but the time element of the conventional POC construction is very important, and we tend to lean on that more. That's where the structure develops in the profile from the element of time that is graphically displayed in the conventional profile. But you see Jim has his volume up, futures volume at price beside the profile, so that we can look at both simultaneously. And I think I've answered that.
The reason I asked Julia to answer that question, because I remember the comment she made to me a long time ago. People wanted, and she used the beautiful phrase, why do they want to pit one against the other? When people would ask this question, it was like, you know, people wanted to do battle over this. And Julia said, I don't know why that would be the case, because they both have value. And so she really had a great handle on this. One of the things that I do, I'm looking at actual volume right here. Now, here is the gap. Here's yesterday's low. Now, if I am short, if I'm a short-term trader and I am short, the first thing I said, I would have drugged my stop down to here. Now, if I were short, I would move my stop to maybe about right here. But also, if I were short, if I'm a short-term trader, I'm not talking about a long-term trader. If I'm a short-term trader, I would probably be covering my short right about here. And the reason for that would be, this is just a personal preference. The reason for that would be, if there's going to be a problem, it's more than likely going to happen right here. If the buyers are going to surface, it's probably going to occur right here. You see, so it's looking at the gap. This is a very important level. We're one tick above the gap right now, and remember, if the gap is filled, then you want to see the market continue with some acceleration to the downside. But right now, you can see that it's right one tick above that gap. And if it's short-term traders, it's not unlikely to see them come in at this level.
Jim, can you just talk briefly? You consistently say do not fade a one time framing market, and I realize we only have the first two periods in, but we are one time framing down. But we talk about how important context is. In this particular case, we are coming into this gap, so there may be reason here to fade if we do not see acceptance below 1689. But will you just discuss that briefly here?
Well, there's a little conflict because I've got higher value, and the one time frame is only down in two periods. So right now, I say I'm looking right now. My focus isn't on the fading. It's really right now. It is on will it or will it not fill the gap. if the gap isn't filled, this is an interesting situation because you see we are within one tick of filling that gap. Short-term traders know that gap is there, and that's where there's an awful lot of focus going on, right now. I would not be long in this market. I would, if it fails to fill the gap, I might go long. If it bounces up here a little bit, I might go long with the stop if the gap is filled. But right now, my short side, I would have a stop right here, and I'm watching very carefully to see if this gap is filled. Now we've filled the gap.
Now we look at Unchanged. Excuse me.
Now we look to see if we can get Unchanged.
You can mark that too if you want, Jim. I don't know if they know that green circle on yesterday's profile is Unch. But clearly they're causing some pain for the overnights who got really excited, emotional trading, weaker hands, and they're, many are, to use a technical term, puking it as we speak, because we're still not seeing heavy volume, but price, and people follow price, price is indicating that the auction is moving lower. So now we start to wonder, is this just an adjustment of overnight inventory, or do we have something more? If you would visualize a daytime or daily bar chart, are we seeing excess in today's session where we looked above it, took out the overnight high, we've now entered back into the range. And again, there's only so much we can concede with the time that has passed, but nonetheless, our next monitoring for continuation, if you were still short, is Unchanged. Then we have the point of control below that. So the poor high from yesterday has been cleaned up. We only consider structure repaired or revisited when it's done in the pit session, and we have seen that so far this morning. Now we're monitoring. Breakout failures are powerful trades, but they take a little patience to, if you're going to stick it and stay with your trade and, try and press it as much as you can to get as much as you can. I'll stop
okay,
there.
now monitor the lower right-hand corner here. You'll see it's at 7:14, so you got 15 minutes until the time changes. The next thing you want to see is acceptance below yesterday's high, and this is to be a big one right here. Julie has to mark this Unchanged. Unchanged is a very common reference for short-term traders. Also, they're going to be looking at the point of control, as well as, don't forget, this is the overnight low. The overnight high and low are always references that we want to keep an eye on. So right now, we're aiming at the overnight low. We took out the overnight high. We're now aiming for the overnight low and Unchanged. As I said earlier, I would drag my stop to here. Now, if I were short and staying short, I would drag my stop to just a few ticks above yesterday's high. Eventually it'll get stopped out, but it's just a question of how do you put a trade on and monitor for continuation. What we said early on, if you've got anything on the downside here, I thought it probably should be a double distribution day, and that's what you've got so far. We're now looking here. The next objective is going to be, you just meet this objective, which is Unchanged. So we haven't gone negative on the day yet. It's still Unchanged. The point of control is next, and that would then be followed by this separation between the upper and lower distribution. This J period print right there was the pullback low yesterday afternoon. That pullback low yesterday afternoon is also another reference. If I trade below that, that tells me that I've had substantial change relative to yesterday. Julia, our time is up. Do we want to take 2 more fast questions?
Yeah, we're going till 10:30. 14 minutes.
Okay,
That's okay. We have an interesting question. Do you believe that now, since we've entered yesterday's value area, we will visit the value area low of yesterday? Different perspective.
It's not, my thought isn't there. I am right now, and I don't know, I don't think about that. Right now, I'm thinking about what do I need for downside continuation. First, I said earlier, if I've got anything in here that's meaningful, I need to get value to be unchanged. If value isn't unchanged, then I'm going to get higher value, or I'm going, and a chance. If value isn't unchanged, a chance for a late rally in this market. So right now, as I monitor for continuation, I'm looking down here at the 17. It's 717. I want to see a C period. Am I going to be able to continue one time frame? I want to see if I can stay and get acceptance below yesterday's high. I'm going to look at, notice this mechanically. I went exactly to the tick to unchanged. Okay, when I go exactly to the tick to unchanged, that is not a sign of weakness. That is a sign of liquidation rather than a sign of weakness in the market. Long-term money could care less about unchanged. That's a short-term money indicator. Hold on just 1 second, please. I'm sorry, I had to see if I had to answer that, and I don't right now. Anyhow, so I'm focusing very heavily on unchanged. So this is when I say when I monitor for continuation, I will come back to the value later. So right now, I want to see if I don't find acceptance below unchanged, then I know that short-term money came in to buy the market. Let's go over to CQG, and you will see up here, see it's exactly unchanged. Now we went negative by 1 tick.
Testing the overnight low. Pardon me.
Testing the overnight low. I mean, that's what these markets do. Okay, I'm going to step aside for just a second.
Could you?
I have to do a trade. I'm going to cover some shorts that I have. Just a little bit. So I'll be with you in just a second.
And Jim.
Julia.
Oh, go ahead.
Julia, while we pause, perhaps you can shed some light. What that last question was referring to is we often talk about Jim's destination trades, where we watch in and out of balance relative to the previous day's high and low. In today's case, we opened out of balance to the upside. We have filled the gap, and we have now re-entered balance. So our understanding is that the destination trade becomes yesterday's low, and that was kind of what that question was pointing at. Obviously, we have to monitor for continuation, and if we do not see action below unchanged, and we see mechanical trading right to unchanged and right to the overnight low, we see stopping there. But in general, if you were a longer-term trader, is it reasonable to begin targeting yesterday's low as a destination trade?
It's a great question, and the answer is...
Oh, I'm sorry. I'm back.
Okay. Jim, I'm just showing my window trader. I have histograms beside the numbers to be a little more visual for me. Cynthia was asking Jim about if we are a longer-term trader, and again, it's a great question. It talks and really speaks directly to what time frame do you trade. Is it a valid destination trade, Jim? If we opened outside of range, we filled the gap, we potentially have a breakout failure on the daily bar, which is a slightly longer time frame than the day time frame. We're now talking a short-term frame trade. Is a destination of yesterday's low a viable destination for a short if you're in it right now? Cynthia, do you want to elaborate on that question? Have I asked it correctly to Jim?
Yes, Jim, I was just adding on to that last question that Julia had come across. What the trader was trying to reference is we talk about your destination trades. Today we opened out of balance to the upside. We filled the gap, came back in balance, in reference to yesterday's high, and we talked about the destination trade then becoming the opposite side of balance down to yesterday's low. So clearly we have to monitor for continuation, and if we don't see that, we have to change the plan. But can a longer time frame trader look at yesterday's low as a reasonable reference?
Yeah, I usually, what I do is I take it a chunk at a time. The first chunk, rather than going immediately to yesterday's low, I will go to, Julia, can you still see my screen?
No, I have up my screen, Jim. And before we leave it, I just want everyone to take a note of the volume that came in at this 1688.50 level near unchanged, near the overnight low. We're seeing a pop off of it, but this is where volume can be helpful in monitoring a trade. And I just want to point that out. We're going to go back to Jim's screen. There you go, Jim.
Okay, hold on. Okay, Cynthia, like I said, if it's a longer-term trade, I take it, one step, one chunk at a time. My first chunk, since I see yesterday as two distributions, my first chunk is down to the low of the upper distribution. So that would be, if I'm going to get anything on the downside, that is the first thing. If I make that, then I switch and my next destination trade becomes yesterday's low. For monitoring for continuation, I'm looking down here in this right-hand corner. It's 7:23 my time, 10:23 New York time. I'm going to change times in 7 minutes. Right now, I have still not demonstrated acceptance below yesterday's high. I've traded below it. I went exactly to unchanged, and like I said, when I saw this go exactly to unchanged, and there was no real push to the downside, I covered some shorts that I had, and but I'm a short-term trader today. But right now, if I'm going to make even the first destination, I have to get acceptance below here. I'm looking at the time. I've got 6 minutes. The market regulated itself via time. All I did was go down to the unchanged and the overnight low, very common short-term reference. So one step at a time. If I have a shot to get to yesterday's low, then I need to get acceptance below yesterday's high. I need to find acceptance at the lower end of the double distribution. Then my next target becomes yesterday's low. That then becomes followed by a really more significant trade down to the top of the gap that I think is at about 1660, 1661. So and I always have multiple time frames in mind when I'm looking at this thing, as well as the potential. Julia was talking about the volume came in right here. This is very significant. This is a logical place where buyers come in. And Julia wrote about this the other night. This is a logical place for buyers. The market rallies. If the market then comes back through this, what is likely to happen? These short-term buyers that were buying it unchanged automatically and buying at the overnight low, if the market comes back through this, they went from buyers, they can become sellers and forced to liquidate, and then you start to see some real acceleration to the downside. So this is a very important reference, and this is what she wrote about. I think you would have gotten it the night before last on there. What was that article went out, right, Julia?
Yes.
Julia, are you
yes.
there? Yeah.
Yes, it did. Cynthia has it. Many do have it, but she can forward that on for traders' edification later. But yes.
This is a very important reference right here. If this had been sellers, you're not going to have bounced. So the chance, if this was been sellers, you'd have gone straight down. More than likely, short-term people got long right there. If we come back through that, be very careful because this may see acceleration to the downside. So if I had bought this down here, I'm going to have a very tight stop, and that tight stop is going to be right about here because I don't want to see it trade back to this. Now I'm talking very short-term trades, but I know that's what a lot of people do. If I was a buyer here, I need to see the market find acceptance back above this level, and really not come back down here. I need to see it get above this and start to get some legs and climb back up. Right now, value is going to be higher. It's going to take an awful lot to get value lower in here. Okay. Another question.
If I can just show, we don't have any questions. Anyone that wants to chime in and ask any questions here, please type them in. But we're looking at my chart right now. If I can just get some. Right now, as Jim said, you know, and we were commenting, the volume came in at Unchanged in the overnight low. And obviously, there are people liquidating. They're buying, people getting on to try and buy the dip. But they're adding, there's long inventory here, people coming in. If this, what often happens, you'll see a pop off of it, which we did, and then it comes back through it. Well, now these longs, you know, if it goes through that level, they are going to need to cover, or they'll get anxious, and as they cover and sell to liquidate their long position, that can add fuel to the downside tone that we have, you know, that has been here for the last half hour. So this volume level, particularly at the references that we always use, the overnight low, Unchanged, or yesterday's high, you know, this becomes significant. And sometimes what you'll see is the market will go through this volume level. Finally, everyone has puked it at the lows who were long from overnight. The daytime frame pit session longs, they decide this isn't such a great idea, and you'll see a little blip down, but then it's over. The laggards and all participants have kind of, you know, been engaged, and then you'll often see a counter rotation or a counter auction go back up. And if we're trading value and not price, and we're cognizant of where we are relative to yesterday's trade, it may be a valid place to get out of your short. I often press my trades too much. I see it, I know it, but I just can't help myself to say maybe there's more here, and I give a lot back. And so this is a time where you could get flat, your mind is clear, slate is clean, and you can wait for another opportunity. You'll be surprised, or I am, that oftentimes I can get in at a better price with a more objective mind if I choose to go short again. But right now, and we've been carrying forward the confidence from this morning, yes, price pushed lower, but we didn't see a lot of volume relative. If you look at the histograms here, we didn't see a lot of volume coming in, and now we are, obviously, as we get there's some exhaustion here. But, you know, just to know that the confidence on the downside, although price was indicating to us that we had something, recognizing the confidence in the volume at those price levels lower, you know, it's important to just keep it in mind. And it's a more ambiguous concept, and it's a more ambiguous observation, but nonetheless we have to bring it into our trade monitoring and not get the idea that this is a big home run and you know, throw caution to the wind. We just need to stay really alert here. And again, so you can see how the market is trying to pull this over on the people who got long, and you know, we'll see if yeah, I'm sorry, go ahead.
Okay, all right. Notice what we were talking about before. We're back through that volume. Also, look, we have changed times. Very important. We're now at 10:30, and we do not have a good low. So we are continuing to one time frame lower. When you see a market that's bought exactly at Unchanged, we may rally from there. But that tells you that is weak hands traders. They don't have the staying power. They may rally, but that's not strong money. New money, new longer-term money that's going to take this market higher is unlikely to buy it exactly Unchanged. Anyhow, I had covered some shorts. I flipped them back as Julia was talking, and you know, I went a little heavier back because we didn't get much lift out of that. anyhow, so we do not have a good low anymore. The overnight low right here continues to be a reference, and good trading. Right now it's one time framing lower, and until that stops, the trend or the tone for the day is lower. I want to thank all of you very, very much, and we hope to see you join us for our 60-day intensive. Thanks again. Cynthia, thank you very much.
Thank you, Jim.
Jim, we thank you very much. Team, we appreciate that you have all stepped in for this webinar. We are very honored to have Jim Dalton with us today. We thank you very much for taking your personal time just for our team. And Julia, thank you for all of your organization and putting this together for us. This has been outstanding, a fantastic learning opportunity. And I do hope that each of you see the value in having the opportunity to have Jim call it live. He has agreed within the 60-day intensive to actually do this one time per week, to actually be on for a whole specified morning or afternoon session, to call it live, to walk you through the steps, walk you through the targets, the stops, all of that kind of stuff. And I think it is an invaluable opportunity that each of you should seriously consider looking into. I'll turn it back to Julia. Thanks again, Jim. We really appreciate it.
Well, one more comment. Cynthia was the reason that we are going to spend more time being live during the course. She had emailed Julia and said she would be far more interested if we spent more time live, and we agreed to it. I had remembered talking to Cynthia some couple of years back, I think it was, and I remember that time was serious. So we took her comments very seriously, and that extended the amount of live time that we will spend during the session. Once again, thank you all very much.
Thanks, Jim, and thank you, Cynthia. Really great to have everyone here and have Cynthia so involved in this process and bringing her expertise to the analysis. So we thank you all very much, and we see that volume got pulled over on them, and now we see some liquidation. So this is a great way to leave it, and Cynthia will be sending this recording link out to everyone so that you can review it. That's an imperative part of practice, and I know Cynthia lives that every day. So we'll get this recording out to you, and we welcome any questions going forward from here.
Julia, I can't help, since we're still live, I can't help. The market is down to that afternoon pullback low and the lower distribution. One of the most valuable things that you could have learned from this morning was when Julia talked about that volume at Unchanged, where it came in at Unchanged, and we said if it bounces and comes back through it, watch out, that becomes fuel on the downside. You saw that happen exactly. People ask sometimes, do we monitor order flow? And usually when they ask that question, they mean, do we follow the bid-ask ladder? Our answer is no. What we monitor order flow, as you saw right here. That's a different way to look at order flow. We want to know what real people are doing. When we saw the volume come in at Unchanged, I already said I know that's weaker hands volume, that's short-term trading money, because that's not what longer-term money doesn't wait till exact price. Well, if that doesn't carry through, which it didn't, then you're looking at the potential for that to be taken out and actually to be fuel to the downside, which is exactly what happened. That was one of the most important observations of volume you will ever see. Once again, thank you very much.
Thank you, Jim. And there was a question, I can answer it, Jim, but the calls that Jim bought were weekly calls on the futures, not on the cash. He bought 1690.
Weekly calls on the futures. They expire this Friday. They were on the 1690 calls. They were because the high didn't look any good. I paid $405 for it, which would mean they're just a little over $200 a piece. As the market rallied, I was able to get short futures against those calls, and as you can see, the shorts are working out very, very well. Thanks again, guys.
Thank you, Jim. Cynthia, do you have any last comments before we go or questions?
No, this has been fantastic. This has been absolutely outstanding. I just appreciate you guys taking the time so much.
Well, we appreciate you, and we're excited to have, new traders in the, interested, and thank you very much, Cynthia, and thank you to your team and everyone who's here to hear Jim's work and be a part of it. Thank you very much, everyone, and great trading to you this afternoon.